Nadisha in Chicago, and you're watching my channel, Knowledge for Quality of Life. Friends, I welcome all those who have recently joined the channel. And as I suggested in the past, that if you have any comments, concerns, or if you like to hear any particular topic which I may have experienced in my life, please include in your comment section, and I'll try to address those. If I am aware or if I have gone through some kind of a reading or some experiences, and I will be happy to share with you with the references. So last time we looked at it, basically a 22-year-old earning a salary of $68,000, and how much the person is going to need 35, 40 years down the road when he or she retires. And we looked at the asset performance over time, and we realized that small cap stocks outperforms in the long horizon than the large cap. And the returns are much better, like 2 to 2.5%. But in the long run, even 0.5% or 1% makes a huge impact, because this is not 2 plus 2 equals to 4 when it comes to compounding. If it's a simple addition, then it's 2 plus 2 is 4. But when you talk about compounding, 2 plus 2 is not 4. So it works totally differently. And today, what I wanted to show you some concept of factor investing. Now, this concept was given initially as a part of the academic work by Eugene, Fama and French at University of Chicago. And in early 90s, they've been awarded a Nobel Prize on their work. And this is a capital asset pricing model. So basically, they have given the three indicators, the three factors, but in 2015, they added two more. So there are 5 factors. It's called 5-factor investing model. And we will look at it, a little bit, from the understanding point of view that, what they include and how they can enhance the returns on the long horizon. Now, when we talk about investing in different assets, and we looked at it as small stocks outperforms the larger caps, larger stocks in the long run. And again, then there are further nuances in this, that there are growth capitalization stocks, small cap growth stocks, small value stocks, large cap growth stocks, large value stocks. So the style depends also. So one of the factor of style is included in this 5-factor investing model as well. So let me share my screen, and you will know exactly what I'm talking about. So basically, this is a Fama French 5-factor model. Is an asset pricing model developed by Eugene Fama and Kenneth French to explain expected stock returns. It's an expansion of their earlier 3-factor model, adding 2 more factors, which is profitability and investment. The original 3 factors, as I mentioned, focus on the market risk, company size, and the value. Means style of the investment, whether it's a growth company or value-oriented company. And remember that value is always attributed to bargains, when things are out of favor. So basically, these are the 5 factors. The 5-factor models, number 1 is market risk, which is measure of beta factor. Now, if you look at in the investment catalog like Morningstar, Value Line, each stock and each funds it indicates a beta factor. So beta is a measure of risk. And for instance, if overall market, let's say if S&P 500, Fortune 500 companies has a beta factor of 1.0, then they calculate the mutual fund beta factors, or that particular stock beta factors, that how they are behaving in comparison with the overall market. So market beta risk, overall market is 1.0, and if company has a beta factor of 1.1, it means that it's 10% more volatile than the overall market. It's applicable same way with the mutual fund as well. So one is market risk. The second is company size. We saw that smaller the company, bigger the performance in the long run, because they have a lot of room to grow over time. Because the company which has grown big, they have a limitation in growth. So basically, if you think of a growth as a S curve, so small companies are basically at the tail end, and they have a lot of room to grow to go at the plateau level. So smaller companies has of course, a bigger risk and bigger reward as well, because I mentioned earlier that risk and reward goes hand in hand. Then the third factor is a value. Value is like if the company is trading at a bargain, or it's trading at a premium. So it is measured, the company stock is measured with a low price to book ratio. Value stocks generally outperforms those with the high price to book ratio. So price of the stock divided by the asset book value, you have a number, and that predicts one of the factors that whether the stock is trading at a bargain, like for so to speak, they are on sale, or they are trading at a premium. So if they are trading price to book ratio of 1, it means that price of the stock is trading almost at the book value. So that's a 1. So if anything is less than 1, it's trading at a bargain. Now question is that how much bargain? If the stock price to stock book value is at 0.3, so it means that it has a 70% bargain. It's trading at a 70% off. So basically, that company or that fund or that group of companies are selling at a extremely bargain. So this is a value, and normally price to book ratio, which is 1 greater than 1, they are growth, and with the momentum stocks or momentum stock mutual funds, those hold growth oriented stocks in their portfolio. So the fourth factor is profitability. Profitability is a company with high operating profitability tend to have higher returns, and return spreads between the profitable and unprofitable companies. So the company which company picked by the fund manager or a portfolio manager, he decides that which are the companies which are trading at a profitable margins, and then that's how they go with. So fourth factor they added, in 2015 as a profitability measure. The last one, the fifth, is investment. Investment companies that invest conservatively tend to have a better returns than those invest aggressively. So those companies who are in conservative approach in investment, they think twice before they put their dollars to work. They tend to do better in the long run as far as the returns are concerned than the companies which spends money frivolously or without evaluating or without taking the risk reward assessment, means they are not very frugal with their money, and they tend to do not better in the long run. So companies who invest aggressively, their investment, they don't perform as well as the companies who invest very conservatively. In other words, they are very frugal in nature. All right. So these are the 5 factors which makes a huge difference in the long run. Now let me share my another screen with you. So this is a chart I wanted to share with you. All these 5 factors are shown here, and this is the source of DFA funds, dimensional fund advisor funds. They have on their website. Basically, they have categorized all these 5 factors. Not that I'm promoting their funds, but it's a good piece of information which captures all those 5 factors of investing in the long run. So here you see that U.S. stocks, particularly U.S. stocks from 1928 to 23. Here is the international stocks from 75 to 23. Because prior to 75, they were not in a position to keep a track or record the data that effectively. And international stocks were not that huge prior to 75. Not that they were not available, but the data was not available much, and nobody was tracking as far as collecting the data is concerned. Now, emerging market, the same thing, that they have a better track record for the data from 1990 till now. And so basically, these are the dates which are given here, so we can rely on their data. So first is market premium, market risk. So if you look at here, you have categories of stocks now here, and then here, this is the return between this time frame. 9.82% stocks. Okay, this is stocks means overall. We are not categorizing yet that small or large or whatever. And then T-bills here, treasury bills. So whatever the stock minus the T-bill spread. So if you take this minus this, you have a spread of, stocks perform 6.56% better in the long run between 28 to 23 as compared to the T-bills. Same here with international stocks. If you look at the long-term performance, 9.9. They did better a little bit than the U.S. stocks. But remember that, they don't run in tandem, side by side. They do have some correlation based on the geopolitical and economic conditions of the globe. But, they have their own cycles, which I'm going to be talking separately in a separate vlog because it's outside the scope of this vlog. So the T-bills here, for the international category, 4.27, and spread is this minus this, 5.63. Emerging stocks, again, though they don't run in tandem with the U.S. stocks, they have somehow they do have a correlation, but not that great, because they are the currency translation, the currency exchange plays a role, and a lot of other factors, geopolitical concerns and all that. But they tend to do much more, plus and minus in their returns because, they are volatile, because most of the emerging market companies are nimble, small. And of course, the smaller the companies, greater the risk, but reward is also greater. But, they run in cycles as well. So we will look into it later in a separate vlog. Now here, size premium. So if you look at the size premium, that here the gray bar says small and large. So basically, small company stocks in the US performed better, 11.91% between this time frame as compared to the large ones. Okay, this is overall, not considering value or growth. This is overall. Now, same thing here, small. So small phenomena is critical as compared to the large. So small tends to do better in all 3 categories. If you see here, market risk wise, market premium, all 3 categories are stocks did better than the T-bills. Here, the small did better in all 3 categories, right? So if you look at the international, 13.68%. better. Of course, the time frame were a little bit different, but they tend to do better in the long run. Again, they don't run in tandem with the U.S., and we will talk about it in a separate vlog. And emerging market, 10.04. There is a fourth category also, but there are very few funds available, which we call it frontier markets. So frontier markets is just like getting on the ground floor. Not many people are tracking it. So there's another category of sub-emerging market. Once the frontier markets gets a little bit established, they become the emerging market, and then emerging market gets established, they turn into developed markets. So that's how they move over the course of time. And then third category here is a value. So value premium. So if you look at the value versus growth, here value beats growth. So growth companies return 9.54% in this time frame, and value return 12.53. So of course, in the long run, value always beats growth, because the concept is that when you are buying a value company, it means that you are getting at the ground floor opportunity when the stock or when the fund is out of favor, because you are buying at a bargain, basically. So you are buying something which is on sale, nobody wants it, but if you understood the game plan, and if you bought it and be patient, you will be rewarded in the long run. That's what it tells you here. Again, here in international, value beats growth. So 12.77 versus 8.15. And again, in emerging market, value beats growth. So basically, so far, these three-factor stocks are the way to go. Size, small, nimble. Third, value versus growth. So stocks, small, value, and then let's look at the fourth criteria, profitability premium. So profitability premium, the high profitability, produce 11.78% return versus low profitability, 8.03, right? And the spread is, of course, this minus this, that's the spread. And again, high profitability companies tend to do better in the long run in international category as well, and then in emerging market as well. Here, investment, which companies were conservative and aggressive in their investment. So low investment companies who are very frugal with their investment dollars before they were deploying that cash towards the company's growth, they were much producing better returns in the long run. With the companies who were not frugal with their money, and they were frivolously or aggressively investing, on the company's growth. So the spread is again this minus this, which is 5.39. Again, this criteria was pronounced in international stocks as well, because companies which were very conservative with their investment dollars, they tend to do better here as well. And same thing with the emerging market. So the bottom line here is that the market is market risk, market premium. Stocks is the way to go in the long run. That beats inflation in the long run. Now think about it for a while that, what is inflation? Inflation is the loss of purchasing power over time. Why? Because the goods and services prices keeps going up, and companies are raising the prices as well. That makes the inflation in the long run, right? Now these companies are making these increases in their prices of goods and services. Of course, they are making money. That's why they are increasing the prices. So those investment dollars, those returns made, profits made by the company, gets delivered to the shareholders who own their stocks. So of course, the stocks are going to tend to do better. Now they are very volatile in the short run because of the geopolitical conditions, because of the economic conditions. A lot of factors plays a role, in the short-term performance. But there hasn't been a single period of 20-year time when stock lost a dime. Okay, so it's a data as well. So in the long run, of course, this is the way to go. The second is that, smaller the size of the company. So based on the person's temperament and risk tolerance, they can pick small growth, combination or whatever. It all depends on, how well you can sleep at night, because if you are too aggressive and that doesn't jive with your temperament, I don't think so it's worth it, because, at least at the end of the day, you want to have peace of mind, and so that you can sleep well at night. And then third category is value. Value always, I'm a value investor, so I always go for the value in the long run, because, the data speaks for itself. The profitability means, again, this is a fifth criteria which we looked at it, and then investment criteria that, how much. So these 5 criteria, when someone looks at it and, and manages the portfolio, they tend to do better in the long run, and then produce amazing returns. And we are not trying to make a killing here. Basically, you want to have some conservative approach. So, for instance, if you take a small cap index, Russell 2000, and if the company is employing these 5-factor investing, they may beat decent margin the Russell 2000, because Russell 2000 investing, if you're buying any ETF, exchange traded fund, then probably it's a very completely passive investing, because you are buying a bunch of stocks from that index. But if it's actively managed, employing these 5-factor investing, then it could be less than 2,000 companies. It could be very efficient portfolio, because they are considering all these 5 factors in picking the right companies around the right time with the right pricing model. So factor investing is called actively managed, but their expense ratio don't go as an actively managed stock mutual fund. So I think in the long run, if somebody is investing in ETFs, index funds, this is another opportunity to look at the factor investing as part of their portfolio to enhance a little bit return of the indices. And it has proven so far that actively managed fund with the indexing touch, but with this 5-factor investing, tends to do better in the long run. So hopefully see you next time with another criteria of looking at it, that when to buy and what to do with the investment dollars. And some folks said they may think that oh, I'm late in the game, and I haven't started early enough. But remember that it's never too late. Once you realize whether it's a health matter or personal finance or education, sometimes things get delayed. It cannot be reversed. For instance, health. That's why I started with the health first, because in my definition, in my books, health is wealth. And you can recoup the money, you can recoup the education, because that's not time driven. Because once you lost your health, it's very hard to recoup it. Okay, and if you have money but you don't have a health, what that money is good for, right? Because money can buy the health care, but money cannot buy health. So remember that. So from time to time, I will include those concepts, so that this is based on my personal experience. So hopefully see you next time in another criteria of looking at, what are the cycles of investing between the US and the international. Hope to see you next week.